Welcome back. I'm going to walk you through one of the most expensive mistakes real estate investors make, and it costs them tens of thousands of dollars in taxes that could have been completely deferred. We're talking about the 45-day rule under Internal Revenue Code Section 1031. And I'm not exaggerating when I say that understanding this rule versus ignoring it is literally the difference between paying $0 in capital gains tax and cutting a six-figure check to the IRS. Let me set the scene with a real scenario. You've just sold a commercial office building. The sale price was $850,000. Your cost basis was $350,000. That means your capital gain is $500,000. If you were to pay capital gains tax on that right now, you'd owe roughly 20% federal tax alone, which is $100,000. Add state taxes, and you're looking at $125,000 walking out the door before you ever buy another property. That's the pain point we're solving today. But and this is the crucial word. There exists a mechanism in the tax code that allows you to defer 100% of that tax liability, not reduce it, not spread it out, defer it completely. And you might be thinking, well, that sounds too good to be true. And you're right to be skeptical because it comes with conditions so specific, so time-sensitive, and so unforgiving that thousands of investors blow this every single year. The IRS doesn't give you slack here. Not one day, not 1 hour. Here's the structure of what we're covering. First, I'm going to explain the exact mechanism, the why and how of 1031 exchanges. Then I'm going to break down the 2 dates you absolutely must circle on your calendar and what happens in between those dates. Third, I'm going to walk you through the compliance checklist, including the specific IRS form that's your proof of compliance. And finally, I'm going to show you 3 real-world case studies where investors either nailed this or catastrophically failed it. Asterisk, the mechanism, how the 1031 exchange actually works, asterisk. Let's start with the foundation. A 1031 exchange comes from Section 1031 of the Internal Revenue Code. The rule basically states, if you sell a property held for investment or business purposes and reinvest the proceeds into a similar property, the gain on the original sale is not taxable in the year of sale. You defer that tax liability until you eventually sell the replacement property without doing another 1031 exchange. Now, the phrase similar property has a very specific meaning in tax code. It's broader than most people think. According to IRS guidance, real estate is real estate. You could sell an apartment complex and buy raw land. You could sell commercial office space and buy a rental house. The only rule is that both properties must be held for investment or business purposes, meaning you can't use a 1031 exchange to defer taxes on a personal residence. Here's the economic magic. Let's say you sell that $850,000 building. Instead of paying $125,000 in taxes immediately, you take the full $850,000 in proceeds and reinvest it into another property. You've just deferred $125,000 in tax liability, which stays in your hands, earning you money. If that $125,000 is sitting in a high-yield savings account at 4.5% annual interest, that's $5,625 per year in additional income. Over 10 years before you eventually sell the replacement property, you've made an extra $56,250 just on the interest alone. This is why high-net-worth real estate investors treat the 1031 exchange like gospel. But here's where it gets dangerous. The IRS didn't just say, hey, go find another property whenever you feel like it. They built in a cage made of dates and deadlines. Asterisk, the 45-day rule, the first deadline, asterisk. Let me be absolutely clear about this, because I've seen investors misunderstand this repeatedly. The 45-day identification period starts on the day the sale of your original property closes, not the day you sign the contract, not the day you notify your accountant. The day the transaction closes and you receive the proceeds, or they're placed in a qualified intermediary account. You have exactly 45 calendar days, and the IRS counts them strictly to identify one or more potential replacement properties. And here's the first trap. You must identify them in writing. You can't just verbally agree to buy a property. You must submit a written identification to your qualified intermediary, which is a legal entity that holds the proceeds of your sale and only releases them when you've identified and are ready to close on a replacement property. Let me give you a concrete example. Sarah sold a duplex on January 15, 2024. She closed at 2 p.m. on that date. Her 45-day clock started immediately. Her deadline to identify replacement properties is March 1, 2024, not March 2nd. If her written identification arrives on March 2nd, even at 8 a.m., it's too late. Now, the IRS allows 3 different identification strategies within this 45-day window. Strategy 1, identify up to 3 properties without restriction. Asterisk. This is the most straightforward path. You can identify any 3 replacement properties, regardless of their value. You don't have to buy all 3, but you must have identified 3 by day 45. Then you have until day 180 to actually close on at least one of them. This is what most investors do when they're not sure which direction they want to go. Asterisk. Strategy 2, the 200% rule. Asterisk. This is for investors who want to identify more than 3 properties. You can identify as many properties as you want, as long as their combined fair market value doesn't exceed 200% of the relinquished property's fair market value. Using Sarah's example with the $850,000 duplex, she could identify properties totaling up to $1.7 million in value. But again, she can only close on 1, 2, or all of them as long as she closes on properties equal to at least 95% of the $850,000 value. Asterisk. Strategy 3, the 45-day build to suit. Asterisk. This is used when you're having a property built or substantially renovated for you. You identify the real property and the build to suit must be completed, and you must close within the 180-day window. This is less common but critical for developers. Here's a case study. Michael, an experienced investor, sold a $1.2 million strip mall on March 10th. He identified 3 replacement properties within 45 days, but here's where he made his mistake. He identified properties in different states without really understanding what he was looking for. By day 120, he had offers accepted on 2 of the 3 properties. But then the market shifted, 1 deal fell through. And by day 160, he only had 1 deal actively moving toward closing. That deal didn't close until day 185. He missed the 180-day deadline by 5 days. The entire 1031 exchange was disqualified. He owed the capital gains tax he thought he'd deferred, plus penalties and interest. That cost him approximately $180,000 in unexpected tax liability. Asterisk. The 180-day rule. The second deadline. Asterisk. Let's talk about the closing deadline. The 180-day period also starts on the day your original property closes. This is the absolute outside date by which you must have funded the purchase of your replacement property or properties. Again, this is a hard stop. No exceptions, not even for appraisal delays or title issues. Here's the tricky part. The 45-day identification period and the 180-day closing period run concurrently. This means you can't wait until day 46 to start closing on a property. You actually need to be moving very fast. The practical timeline works like this. Day 1-45 is your identification window, but smart investors start closing as soon as possible within that window, because title issues, inspections, appraisals, and underwriting can all take time. IRS Revenue Ruling 2002-83 clarifies that both the 45-day deadline and the 180-day deadline are absolute and cannot be extended due to circumstances beyond your control. A court case from 2012, Durden v. Commissioner, involved an investor who missed the deadline due to natural disaster. The court ruled that the deadline still applied. This established firm precedent. There are no exceptions. Let me illustrate with another case study. Jennifer sold a fourplex on January 20th. Her identification deadline is March 6th. Her closing deadline is July 19th. She identified 3 properties by March 1st and went under contract on 2 of them by early April. But one of the properties had environmental issues discovered during due diligence, and that deal fell apart. Her second deal was still moving, but slowly. By July 10th, the deal still wasn't closed. There were final inspection issues. She didn't close until July 25th. 6 days late, the IRS disqualified her exchange. She owed roughly $95,000 in capital gains taxes plus penalties. Asterisk. The compliance mechanism. Form 8824 ***. Now let's talk about the paperwork that the IRS uses to verify compliance. This is Form 8824, titled Like-Kind Exchanges. This form is filed with your annual tax return for the year in which you sold the original property. The form is where you report the date of the property you sold, a description of that property, the date you received the proceeds, the identification deadline, the properties you identified within 45 days, the description of each identified property, the date you received or will receive the replacement property, whether the exchange was completed within 180 days. Failing to file this form correctly is a primary trigger for IRS audits on 1031 exchanges. If you're not filing it, the IRS assumes you didn't complete an exchange and reassesses the tax. Asterisk. Real-world case studies where investors go wrong. Asterisk. Case study #1, the over-leveraged flip. Asterisk. David sold a $600,000 rental home with a $300,000 gain. Instead of finding a single replacement property, he tried to do a fractional exchange by buying 3 properties for $200,000 each. On paper, he identified 3 properties within 45 days, but his financing fell apart. He closed on only one property by day 180. The other two deals died. The IRS determined he didn't meet the requirements because he hadn't purchased like-kind property in the way he'd stated. The result, $60,000 in capital gains taxes owed. *** case study #2, the forgotten deadline. *** Angela's accountant told her she had until the end of the year to complete her 1031 exchange. This is false. Her sale closed on October 5th. Her 180-day deadline was April 3rd of the following year. She didn't close on her replacement property until May 15th. She missed the deadline. Capital gains taxes on her $400,000 gain came to approximately $100,000. *** case study #3, the successful navigator. ** Robert sold a $2 million commercial building on February 1st. His deadline to identify was March 18th. His deadline to close was August 1st. He worked backward from these dates. By February 10th, his broker had him in serious negotiations on 2 potential replacement properties. He identified both properties in writing on March 10th, well within the deadline. He then focused on due diligence and closed on his primary replacement property on June 25th, comfortably within the 180-day window. He deferred $400,000 in capital gains taxes. ***, the qualified intermediary requirement ***. One more critical detail: you cannot touch the proceeds of your sale directly. The money must go to a qualified intermediary, a third party, who holds it until you've identified and closed on a replacement property. If you take the money into your own hands at any point, the entire exchange is disqualified, even if you later buy a qualifying property. This is extremely strict. The IRS v. Biggs case established this principle firmly. ***, conclusion ***, the 45-day and 180-day rules are not suggestions. They're not guidelines. They're legal requirements with severe tax consequences if violated. A single day late